Trivariate's Adam Parker joins me now right here at Post 9. He's, of course, a CNBC contributor as well. And you got a lot on your plate, right? Nice to see you. We have the mega caps, and we have a market rally back pretty nicely here.
Yeah.
And then we have a jobs report and a Fed meeting next week. And these comments from the Treasury Secretary, I put a lot in your shopping basket. Which one stands out the most?
I mean, the market's down 4% maybe year to date after being up 25% a year for the previous 2 years. So, I mean, it's not that bad. It's like I'm looking. I like the market less now than I did.
You still like it less?
I like it less now than I did a couple weeks ago because look, the earnings season has been better than I thought, better than anyone I talked to thought. Whether it was the banks, select software, the tech so far. We obviously still have a little bit of meat on the bone during earnings season. There's a bunch of stuff that's in front of us the next, 7, 8, trading days. So we'll see. But we haven't seen what we call real companies like Visa or somebody really tell us things are getting that much worse. So I think a big debate is like, what is the actual lag between what's happened so far when it hits earnings, right? You see this GDP number, and it's like it looks disconnected from what the S&P 500 is reporting. So I'm still of the mindset that I think there's risk to the downside in earnings, and I haven't seen companies act great. So I'm a little bit thinking down 4 isn't that much relative to what I think the damage to the growth rate's been.
But we were down a lot.
We were.
But there is a thought that we've rallied back enough that now valuations, like Rick Reeder told me the other day, now valuations are too stretched again for an environment in which earnings growth is undoubtedly slowing, and so too is the economy. We got some proof from GDP, and you're going to get continued proof, maybe even tomorrow, from the labor market.
I guess I agree with what Rick said. I didn't hear him say that. I just got back from 3 days on the West Coast doing a bunch of meetings, and just like is always the case, the previous 10 days price action changes sentiment. 2 weeks ago, I did a dinner in New York. It was apocalyptically bearish. Everyone hated U.S. equities. It was like, now we've had a monster rally, from the lows, and people were like pretty bullish. Like, well, the second round of tariff news is going to get better, and once the fix 50 and down, it always works, and the technical, blah, blah, blah. So it's like,
yeah, but what's your hang up? I mean, because you're not.
My hang up is what I know is coming is worse earnings revisions than people think. And so you've got to pick this barbell to invest, and it's a different barbell than history. History was, I buy utilities and I buy staples, and then, but now I think it's the businesses, what we previewed before earnings was, it's the businesses that don't have tariff, don't have China, have some pricing power. Doesn't matter if they're cheap or not. You own Waste Management or Republic or Waste Connection. You own Martin Marietta or Vulcan or Knife River. You own anything that's got McKesson or Cencora, or things that have pricing power, margin expansion potential, whatever. That's the new safety, even if it's at 30 times, because who the heck knows? You saw, I think for the first time in my whole life, or certainly my 30 years of looking at equities, that Pepsi and P&G missed in the same day. Or like, that's, if your defensive playbook, if yesterday was, I buy Pepsi and I buy P&G and I buy some pharma, like that's not necessarily the defensive cocktail of success.
What about this? What if, and I think we're getting some evidence of this, what if the pull forward, because this was so well telegraphed, I mean, if you missed the fact that the trade war was going to start and you were going to get the tariffs, you weren't paying attention. You didn't pay attention to the campaign, and you didn't pay attention to anything from the campaign until now. What happens if the pull forward ends up being so significant, not to the same degree, but in the same texture, that the demand on the other side of COVID was so significant that it carried things from a positive standpoint much longer than people thought? So if I'm loading up as a business or a consumer now, and the numbers maybe look overinflated now versus where they look then, it's still good enough to get you through to the other side.
I think that's low probability. I'll start by saying I don't necessarily agree with the way you teed that up, that everyone knew the tariffs were coming, even though you and I were here.
Not
it was
to the
very
degree,
clear.
No one knew the numbers.
Right.
That's fair.
Not just the magnitude, but on January 1st, I wrote my year-ahead outlook at Trivariate. Okay, the street was bullish after the monster rally after the election. We wrote the market will be down and volatile in the first half of the year because tariffs weren't in the price. That was a contrarian view in January. So when companies reported January and guided to April, it still wasn't how they were managing their companies. Forget Wall Street, which is totally wrong. So I think what shifted is it was worse than people thought. Now you're the CEO of a company. You're trying to plan, am I going to what's my production going to be? What's my inventory going to be? And I think the KPIs, the key things you got to look for this quarter are going to be like, what happened to backlogs? What happened to orders? What happened to inventory? I think you're about to find out that things got a little bit worse. And so I think what's happening is not everything's fine. It just got smoothed and pushed out to Q3 and Q4 a little bit. And so I think the risk is that Q2 numbers and Q3 guidance are a little bit worse than people thought. And so I'm with these folks that I think you've got to be more cautious now. Every meeting I did this week, though, people said, God, I can't afford to not own something for offense because that day we were up 10% in one day. If I'm all locked into the conservative stuff, I just lag by so much. What offense can I own? And so I spent a lot of my meetings going through that. I do think it's interesting to maybe take a look at a lot of these alternative asset managers that really got killed.
For the private equity names?
Yeah, KKR, Blackstone, Apollo, Ares, even Morgan Stanley and Goldman, right? Like, if you do believe that on the other side of this is some economic improvement, I think they've sold off a lot. So I think there's some things you can add to the offense side. I just don't think yet that it's as easy as the train left the station and that was just a one-time ripple and we're all good.